All right, everybody, welcome back to another episode of the Discovering Multifamily Podcast. I'm one of your hosts, Anthony Scandariato with Red Knight Properties. And today we have a special guest here with us, Ryan Mapes, coming at us from the California Bay Area. And he's got 15 plus years of experience leading different high growth startups. And most recently, his startup we're going to talk about, he's the CEO and co-founder of Release, which is tryrelease.com, which provides short-term funding for multifamily real estate. So what exactly does that mean? And really looking forward to digging into the conversation with Ryan. So thank you for coming on our show.
Yeah, thanks for having me. Really excited to be here today.
Awesome. So tell us, just tell us about your platform. Obviously, you got a tech background, and
Sure.
Real estate's kind of been the lagging industry to implement technology. So very interested to see how your platform helps real estate owners, operators, syndications, etc.
Yep. Yeah. So Release provides short-term working capital to multifamily owners, and we do that without requiring additional debt or equity dilution. So a pretty unique offering there. And the way that mechanism works is that we allow you to trade a portion of your future rental income in exchange for cash up front today. And so if you want to think of it's not exactly this, but think of a mental model. It's somewhat like factoring. I think a lot of people get that pretty quickly.
Yeah, that makes sense. And this hasn't been implemented in our industry.
We haven't seen it yet so far. It's fairly unique for us. What we do is we're a marketplace, right? So we connect multifamily owners who are looking for this working capital. They come through our platform. They add their properties. We do all the underwriting. But then we're actually connecting them with institutional funding on the other side. And that's how we're able to get relatively low cost of capital and also high liquidity across the board.
So this isn't a loan. So for people who don't understand factoring, how does that work?
Yeah, that's right. So it's not a loan, right? So, the way that you would typically account for this, right, on your books at the end of the year is as if you're pulling your rental income forward, right? And so, certainly, speak to your accountant, right? You want to make sure you're doing it on the up and up, but it's not a loan. You're not repaying a loan here. You're pulling your revenue forward. And so you're trading a portion of that future rental income in exchange for cash up front. We provide a discounted rate there, right? So if you wanted to think about it like in loan terms, right, there would be the equivalent of an interest rate, but it's not actually a loan. So you're not levering up your property, right? It doesn't show up as additional debt there, which is a huge, huge benefit to most owners.
Okay. So if you, so how do you guys make money then? If there's no interest, being charged, or is there other fees associated with it?
Yeah, that's right. So we take a percentage of the spread, right? And so if you're a multifamily owner and you come to the platform, you're looking for funding, right? We would give you that funding, but we take a discounted rate. And so you might think of that in traditional terms, almost like an interest rate. And so, today's rates on the platform, you're probably seeing a sweet spot of, call it 8 to 12%. We take a portion of that. The rest is passed through to that institutional investor. So that's how we make our money.
Understood. Okay. And so how does it work from operation standpoint from the owner? Like, how do you verify the owner's P&Ls really? Because they could, do you have certified financials sent? Like, how does that work?
Yeah, it's a great question. So, through our underwriting, you come through the platform, right? Almost as if you're going through a traditional, bank underwriting. It's a little more lightweight. I think most owners find it to be much easier to go through our platform. But you add a bit of business information, you add some property information. Critically, you sync your bank account, right? So we have read access to your bank account. Okay. And so then we can verify, obviously, transactions coming in and out. And of course, then you provide some additional financials, trailing income statements, rent rolls, what have you. And so we can underwrite from there. That's a great question.
Yeah. And in terms of, setting up, so you're linked to all the major financial institutions,
That's
I'm
right.
assuming. And then how long does it take to get funded? Who's like the archetype client, multifamily client for you guys using your platform?
Yeah. So we can fund very, very quickly. We can fund in a matter of a few days. And so, often owners think of us as a better alternative to bridge loans, hard money lenders, those types of solutions, relatively inexpensive and very fast. And so, it's quite beneficial there. The perfect architect or archetype for us is really somebody that owns probably 100 units or less, right, in a given property. Total portfolio size can be much, much larger for sure. We see that a lot, but it's typically under 100 units or so. As you see individual owners or JVs or even syndicators get much larger than that on a given property, they typically have other financing options that they're turning to there, right? And so for us, broadly speaking, across the country, it's 100 units or less on a given property.
Got it. And then what are the limit? Like, what are the sizes you're approving, not approving? Like, is there a limit to your funding amount at this point? Or
yeah. So we could go technically as low as a duplex, really there, right? But as you think about scale, we can lend up to a couple of $1 million, right? We could go higher in certain certain instances. But really, you see this sweet spot in the few $100,000 range is typically what you see, right? Owners are coming through really for a couple of use cases. One is certainly, and obviously, hopefully repositioning, right? You're renovating units and, you're trying to turn units and you might need some working capital rather quickly, right? You don't want to have the opportunity cost that comes associated with traditional bank financing. And so you might use our platform for that. The other that we see a fair amount actually is that owners want to have money for perhaps a down payment, right, for a future property. And so they'll use funds for that as well, right? Because it's still their money. They're just pulling the revenue forward. Again, it's not a loan.
Understood. Okay. And then what is the repayment? I know it's not a loan, but
Sure.
Yeah, how long, what's like the longest duration to take future cash flows coming in that
Yeah. So today we do it on a 12-month basis. So we'll underwrite, the next 12 months of your future cash flow, and repayment occurs over a 12-month basis as well. But we do have a mechanism that allows you to extend that period. And so, you could almost think of it as a line of credit, right? So we have some owners that do that as well, that like to just have the cash available. Sometimes they tap it, sometimes they don't. And you can easily do that right through the platform.
Interesting. Okay. And then in terms of, I guess, I don't know if you're accounting background, if you have an accounting background, I'm sure you have a team of accountants, but in terms of if I don't know how you'd be reporting, I guess, income that's coming in, and then you got to pay you guys, then you're receiving the income in different books probably.
Yeah. Sure.
How do you maneuver, or is it up to the clients to figure out?
Yeah, sure. It's up to the clients. We typically don't run into any challenges there, right? Usually the accountants, again, they cover it by pulling the revenue forward. And so you're recognizing the revenue by pulling it forward there, and you're paying that fee that would be equivalent to a traditional interest rate, right? On a traditional loan, you're paying that fee up front, actually, right? And so let's say, for example, you had an 8% discount rate, again, effectively 8% interest. If you're thinking in traditional loan terms, you would pay that fee up front when the money is given to you right away, right?
Right. Okay. So then that will just come out of whatever bank account that you have linked to the platform, and then basically just to almost think of it as the principal of the future rents, right, being paid for whatever time period.
That's right.
And then, so in terms of access to the capital, from sending in your financials or linking your bank account to your ask, whatever, say it's $50,000 or whatever it is.
Sure.
Like from your ask to your approval to your fund, like what are the steps between that?
Yeah.
And how long does it take?
Sure. It happens very, very quickly. And so, as you come through and you add your property to the platform, you could do that as quickly as 5 minutes, maybe 10 minutes. It's very fast, right? As you come through, especially if you have your financials readily available, which most of us do. And so, it's very, very fast to join. Underwriting typically takes a couple of business days in here. You're given an approval for a trading amount. Think about that as the funding amount that you could go get. You take a look at it. You can take up to that amount as your maximum. You could take a percentage of that. It's up to you completely, however much cash you need. then you literally click right in the platform and say, hey, I'd like to get the funding. And then, we send you the agreement over there. You can read the agreement of all of the repayment, how it all works. And we wire you the money that day or the next day, right? Whenever you sign that agreement. So it's very, very fast. End to end, it can happen in a matter of a few days.
Yeah. And again, this is not a loan, so it's a little bit different.
Correct.
Have you seen cases where, you technically have a balance, right? And then you just got to pay the balance off within that time period. Have you seen cases where an operator would just pay it and they take the money, they do whatever they want with it, and then somehow maybe they refinance something else and they get cash and then they just pay this off, or they have little incentive to do so because they've already paid your discount rate up front, and it's just, it's there's not really interest moving forward because they already made that.
Yeah, so we do see early repayment actually fairly often. There's no penalty for early repayment, and so you see that occur, actually fairly often. We're synced to your bank account, and so the repayment happens as a percentage of your free cash flow on any given month, right? And so we take that repayment over time, and we're pretty good at predicting how much of that repayment has to occur monthly in order to repay over a 12-month period. So we try to peg it right there to the 12-month repayment period. Goes easy on everyone, and it's pretty smooth.
When you mentioned trading, are you talking about if you have multiple properties set up in the system and then you're moving funds between different bank accounts? Like, what did you mean by trading?
Great question. You can add multiple properties to the platform, but we think about trading as a two-sided marketplace where technically you're trading a portion of your future rental income to an institutional investor on the other side. So, sort of platform jargon that we use there, but we think of it as a trade since it's not a loan. You're trading your rental income.
So what's the worst case scenario? Is it, let's say the payment, all payments haven't been caught up over a 12-month period, or maybe tenants, there's a really low collection rate for the year, and what you thought you were going to get in 2021 is not what you're going to get in 2022. Maybe it's 25% less, and you're having troubles with repaying. What happens then? If you're not able to make those payments, and if you don't have enough funds in that particular account that's linked, do you then place a lien on the asset or on the entity?
We don't actually. We don't place a lien on the asset itself. What will happen there is that repayment will extend, right? And so that's what we're predicting in our underwriting is what's the likelihood that it extends beyond 12 months. And then we price that in, right, to the amount you get. So rather than having maybe an 8% discount, it's 9 or 10 or something like that. We predict that. We also apply trading limits as well. So a number of ways in the mechanics that we can mitigate risk there. But it's a great question.
Okay. Yeah. So that's how you guys think about that. Okay. And in terms of, you mentioned trading limits. So that's one of the ways how you can calculate it, just by looking at past performance and then, creating a projection.
That's right.
Interesting. Okay. And you can use this even though you have because this is not a loan, you have a lot of operators have debt on the property, so there's no position being taken on the asset.
Correct. Yeah. So that's the beauty of this mechanism, that we use here. It works in tandem with existing debt on your property itself, right? So works beautifully there. If you have debt, it's fine. If you don't have debt, that's fine too. It's independent. It's not a loan.
Very interesting. And how could someone look to get started?
Best way is to go directly to the site itself. It's tryrelease.com. That's TRY release.com. And certainly you could contact me as well. I'm Ryan at tryrelease.com.
Awesome. Well, we're going to keep it short today. We're running a little bit late. But Ryan, thank you so much for coming on our show. We really appreciate the time. And if you liked what you heard and or saw, please give us a rating and review on iTunes, and we'll have a link to Release and Ryan's social media platforms as well in our iTunes description, as well as in our social media platforms. So thanks again for coming on, Ryan. Really appreciate it.
Yeah, likewise. Really appreciate it. Thanks for having me. I really enjoyed it.
Thank you.